news and market movers. This is The Pulse with Francine Lacqua.
So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. The Republican presidential nominee, Donald Trump, says the president should have some say over U.S. interest rates and monetary policy.
Thank you very much. Appreciate
now, such a move would go against the long-standing practice of keeping the Fed independent from political actors. Now, Trump has repeatedly complained about the issue and criticized Chair Jay Powell for being both too early and too late on moving interest rates.
I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Let's bring in Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, thank you so much for joining us. I remember, all of these memories about, Donald Trump calling the most valuable player, improved player, and Jay Powell, he appointed him. But then are we going to see that again if he's president? And are we actually talking about the central bank possibly losing independence?
Well, this was reported a little while ago as well, that Fed independence could be challenged in a Trump administration. And then markets got nervous, but then it moved on to the other kind of drivers. So I think there is a risk of that as we think about kind of scenarios that could play out. And I also think that plays to kind of what investors ought to demand for holding government bonds in portfolios, because if we're talking about this being in question, then term premium needs to increase, and term premium anyway needs to increase to reflect the steeper fiscal trajectory that is going to kind of be the reality that we're looking at no matter who gets in the White House. So all of that goes to show that we need to think about portfolio construction around treasuries more carefully going forward.
And what's also, crazy when you think about it is actually the debt is not part of this conversation. And I know last time we had in the UK the Liz Truss government going after central bank independence, and then there was that disastrous budget. Could we have, a perfect storm where actually an auction goes badly in the US?
Well, nothing is kind of ruled out completely, I would say. And if we look at, yes, you talked about auctions, the 10-year auction this week, the 30-year auction, both saw a bit of a tepid demand, and we saw yields kind of higher than what was expected as logged in the auction. I would say, though, there are so many other factors at play. We need to think of it as a whole portfolio. So whilst the demand for long end of the curve may not be as strong because of the considerations that we just talked about, the demand for income is still firmly in place. And we have seen one of the biggest inflow weeks into fixed income products, especially in the middle of all this volatility. So income is back, and there is a place for front end of the curve, value of the curve. And look at credit. Credit has held up incredibly well in the middle of all this summer volatility and summer market correction. So I think we need to kind of think about fixed income in a differentiated way. Term premium for long end treasury needs to go higher, but it doesn't mean that it has to be a perfect storm for fixed income.
So what's your take? What a week we've had, right? We started Monday, and it was a confluence of things, and we thought we'd be stabilizing a little bit. Then we've gone off the day's highs, I think, yesterday. Are we going to see these bouts of volatility being built in more into the system?
Well, I think if you ask me, or if you tell me on Monday that we're going to see U.S. equities closing the week almost flat, I would have thought, well, how is that going to happen? And here we are. So I think summer anyway generally is accompanied by lighter liquidity, and this together with worries around recession, labor market, worries around Bank of Japan losing the plot with their policy normalization really exacerbated the technical side of things. But I think especially at times like this, it's important to look at, is the fundamental picture really changing? You look at earnings. Earnings are actually coming in really strong. Q2 earning U.S. equity market were tracking 14% year-on-year growth versus 9% expected at the beginning of the quarter, at the beginning of the reporting season. And even for the non-tech part of the U.S. equity market, expectation was for them to grow 2% year-on-year, and now we're tracking 5%. For tech, expectation was for them to grow 18%. We're tracking 20%. So earnings are coming in been quite strong, but it's easy to forget that when we're talking about market volatilities like what we have seen so far this week.
I mean, partly, of course, it's the carry trade, partly is expectations about a recession in the U.S. Have you changed your expectations at all?
No, not around kind of a recession. I think growth is slowing down. That is required to cool down inflation. So that is always in our kind of economic forecast. But we're not forecasting a recession. And we're certainly not forecasting a recession because of the sign rule, because of the rise in unemployment rate, because the unemployment rise can be explained this time by really labor force, labor supply increasing. Since 1970s, the sign rule hasn't been triggered without employment falling within 1 month of the rule being triggered. This is not what we're expecting. This is not the environment that we're in right now. If you look at what triggered the recession fear last week, is the manufacturing print, is the NFP print. But since then, that has given way to a more benign reading of the SLOOS, the Senior Loan Officer Opinion Survey, service strength, as well as the jobless claim yesterday that came in better than expected. So I think it's easy to get quite nervous in the middle of summer in this air pocket, but the fundamental picture hasn't gotten worse, and that's why we reiterated our overweight in U.S. equities in the middle of this market volatility.
So have you changed any of the weightings when you're building portfolios?
Not right now. Not right now. We continue to like tech. We're looking at NVIDIA reporting on the 28th of August. We're also continuing to be positive on U.S. equities, Japanese equities on a currency hedged basis. We have the conviction. I would note that currency, well, actually on a currency unhedged basis, we continue to have the conviction. I would say that currency play, currency overlay has helped our Japan core in the middle of this yen-driven equity correction. Even in the middle of Monday's volatility, MSCI dollar currency unhedged Japan equity was just down 8% from the peak, right? So there is a bit of an auto-hedging component, and we see domestic earnings recovery story continuing as well, which is why we reiterated our conviction.
Wei, thank you so much. Wei Li from BlackRock, of course, stays with us. We'll talk a little bit also about China and some of the other things that we could see in portfolio building in Europe. Now, coming up, Chinese stocks rise after inflation increased more than expected. So we take a look at the world's second biggest economy next. And this is Bloomberg. Welcome back, everyone. Now, investors still concerned about sluggish demand in China, despite inflation in the world's second largest economy increasing more than expected last month. Now, Wei Li from BlackRock is still with us. Also joining us, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So, Wei, thank you so much for staying with us. Gina, welcome to the Pulse. I mean, there's been so much going on in terms of U.S. equities. What have you been hearing from people on the ground? Is now a good buying time, or are we buying the dip, Gina?
Yeah, there's a lot of nervousness still around the U.S. recession and what the Fed may do about it. And I think that this is a particularly complicated time for U.S. equity investors because a lot of what's happening in U.S. equity markets is actually being driven by policy, and not necessarily just U.S. policy, but Bank of Japan policy in particular. If you go back to the middle of July when U.S. stocks peaked and when the broader global equity markets peak, that peak was clearly manifest through a shift in direction from the yen, and then exacerbated when the Bank of Japan started tightening for the first time in 2 decades just last week. So the Fed is really playing a big role here, and not necessarily a very traditional role with respect to U.S. conditions, because as the Fed tries to potentially fight off recession in the U.S., they may have unintended consequences of exacerbating the Japan carry trade that's been unwinding and creating a lot of distortions in U.S. equity markets as well as global equities. So that's really what people are very concerned about, is how much of the recent weakness is really related to U.S. weakness versus just weakness with respect to this carry trade unwind, and how is the Fed going to approach the markets going forward?
Wei, how difficult is it actually to see how much of the carry trade has already been unwound? I think I saw we're 65% there, we're 70% there. Could it be more?
It's very hard to size the quantum of carry given the OTC nature of some of those hedging instruments. But I have also seen reports of, we're halfway through, we're 3/4 through. I think the expectation shouldn't be that we're going to go all the way to everything getting unwound. We're still talking about rate differentials between U.S. and Japan. An interesting chart I was paying attention to was to look at the real rate differentials between U.S. 10-year and Japan JGB 10-year and how dollar-yen has been tracking. There was a disconnect that opened up 1 month ago, and now that is largely kind of closed. So looking at all of that, I think it's fair to say that maybe the worst of the carry unwind is behind us rather than in front of us, especially in the context of Bank of Japan actually walking back from their more hawkish than expected policy normalization stance. Last week, for them to introduce currency as a consideration in their policy making is highly unusual, which is why they saw what happened to global markets through carry dynamics this week. They then came out to say that, well, if there are worries in financial and capital markets, they are not going to hike rates. So that's there, I think, that's as close as we can get from them in terms of admitting maybe last week was a bit of a mistake. They are walking back from that, which is why markets are cooling down a little bit right now.
And Gina, I wanted to ask you about, and Wei afterwards, China's consumer inflation is picking up. There's demands, longer-term demands, or longer-term concerns about, of course, demand. But given we're in a U.S. election cycle, I mean, do you have two scenarios depending on who gets into the White House, Gina, and what happens to U.S. equities?
Yeah, I think that the most important thing is to consider the mix, not just the White House, but also what's going to happen in Congress, because that will be very, very meaningful to determine what happens with the policies toward tax as well as trade. Tax and trade really are the two major levers by which policymakers in Washington, outside of the Fed, can impact equities. And on both counts, both the Republican candidate as well as the Democratic candidate are likely to be somewhat tough on China. I mean, it has not changed materially over the course of the last 4 years. There has still been one big trade impacting the equity markets, and that is the China versus U.S. tech trade. What's happening with that trade has been very persistently underlying a lot of kind of global equity volatility in the semiconductors as well as broader tech space. I don't think that's likely to change. The thing that could change is really trade policy at large. Will we move back into more of a Trump regime that is more tariff related with respect to trades? We noticed in 2018 clearly an elevated degree of volatility in export and import oriented industries related to the trade policies of the Trump administration. So that's something to watch for, certainly. But an even bigger impactor of stocks, frankly, is really what happens with tax. And on this, I think there's a lot of really interesting, compelling opportunities. Both the Trump administration and the Harris administration are likely to pursue policies that are quite different on tax, but they will require commitment from Congress and collaboration with Congress in order to pass some sort of tax policy. And that's really going to be key. So I think that we do want to watch this pretty carefully. Very difficult to price any of this in until the election itself, when we get a sense of not only who's in the White House, but who's in U.S. Congress as well.
And Wei, what's your take, away from this, but also linked to this, on China's economy seems to be battling deflationary pressures. We know about intense price wars. So what does it mean for, again, investment strategy into China?
We have seen today the inflation print coming in a little bit better than expected, but we're still talking about deflationary PPI, right? And that has been plaguing the economy for a while. We have seen the plenum, the State Council, the Politburo came and went. There were some efforts to support the economy. We have seen surprise rate cuts from PBOC, but this is not the bazooka. So structural kind of concern weighing on Chinese longer-term growth, such as aging population, such as the need for reform, they still very much applies. So maybe in response to kind of the near-term effort to support the economy, we see a bit of a tactical bounce, but the longer-term concerns still very much hold, which is why we're neutral China right now.
Wait, are you into the Olympics? I mean, you won 2 Olympic medals at the Olympics in mathematics, right?
In the wrong events, in the not so cool events.
I'm a little bit obsessed with the Olympics. I mean, whoever knew that actually France could play basketball? That was my big takeaway. Gina, Wei, thank you both for joining us. Wei Li from BlackRock and Gina Martin-Adams from Bloomberg Intelligence. Coming up, Kamala Harris and Donald Trump agree a date for their first presidential debate as the two election heavyweights look to land the first blow. That's next, and this is Bloomberg.
The Democratic nominee.
We're in Atlanta, Georgia. When President Biden was on the ballot, Democrats had basically conceded to losing the state. Now that it's Vice President Kamala Harris, Democrats say all 7 swing states are back in play.
Kamala Harris is well known, but she is not well defined.
She's not somebody I've researched too in depth.
She's kind of laid low, but that's kind of what vice presidents do.
You're going to see both Democrats and Republicans defining her in the ways they want those voters to see her.
Success for Harris will mean sustaining the momentum that's been fueling her historic run.
I get chills when I think about that, just being a part of history, understanding that we have someone who represents our communities.
She's also like a really dynamic candidate, especially for like younger people like us.
People, if you asked a month ago, they probably would have said that the country is not ready. But now people are rethinking that, and they're like, oh my gosh, this could actually happen, and I could be a part of it.
Now you can read more of our big take story on swing states online at Bloomberg.com or on your Bloomberg terminal. Now staying with the U.S. election, and Donald Trump and Kamala Harris have agreed to hold their first presidential debate on the 10th of September. Now the two rival candidates will have their first face-to-face clash on ABC News, with Trump confident that he'll hold the upper hand.
She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
Kamala Harris also spoke with reporters about the debates.
I'm glad that he's finally agreed to a debate on September 10th. I'm looking forward to it, and hope he shows up. I am happy to have that conversation about an additional debate for after September 10th, for sure.
Well, Stephanie Baker now joins us, who's Bloomberg's senior investigations reporter. Also, I would add, with the new book out, so we're counting down the days to that. But so much has happened, I mean, I would say in the last week, actually, since she picked her vice president. How do we assess how it's doing in every state and how their strategies will change, both on the Democratic but also Republican side?
Yeah, the past month has been just a political roller coaster ride filled with twists and turns that no one could have predicted. So I think the next month could, equally have changes that, we're not seeing right now. I think for political junkies, they look at something called the Cook Political Report, which put states like Arizona, Georgia, and Nevada, which were previously leaning towards Trump, into play, saying that they're up for grabs now, which I think shows the kind of momentum that the Harris campaign has managed to get in just 2 weeks. I think there's a lot of energy and enthusiasm with the kind of crowds that Harris is pulling. She's in Arizona today for another rally with Walz, introducing him to another crucial swing state. And I think we'll see how the campaign unfolds, and I think the debate is obviously going to be a huge turning point.
I mean, does the Trump camp do things differently? Are they still on the attack, or will they have to regroup and find a better strategy?
Well, the interesting thing is that Trump had very little planned over the next couple of weeks. He's at a rally in Montana, not exactly a swing state. So I think it looks like he's concerned enough about Harris's momentum that he needs to go on the offensive, which is part of the reason why he did finally agree to this debate on September 10th. And gave this press conference yesterday. He, is going to be attacking her. He's, threw out these insults, questioning her intelligence and her competence. And I think, he's going to try to land these attacks on her running mate, Walz, as, a liberal lefty, which I think is going to be a hard thing to do, given the way he presents himself as the sort of high school teacher, football coach, all-American Midwesterner.
Stephanie, thank you so much. Stephanie Baker, there, our senior investigations reporter. Up next, more on politics. Well, Well, good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London, and these are your top stories. Questioning the Fed's independence, Donald Trump says presidents should have some say over interest rates and monetary policy. He and Kamala Harris agreed to debate September 10th. European stocks higher after encouraging data on U.S. labor markets. Well, that's after the S&P actually notched its biggest rally since November 2022. Plus, the billionaire owner of e-commerce giant Temu becomes China's richest person. So JP Morgan now sees a 35% chance of the U.S. economy tipping into recession by the end of the year, up 10 percentage points. Meanwhile, the Goldman Sachs chief executive, David Solomon, predicts that the U.S. will avoid a recession. And Bank of America's chief economist has said the market is overblowing the risk. Now, let's discuss all of this with Michael Spence, Nobel laureate and, of course, senior advisor at General Atlantic, amongst other titles. Michael, thank you so much for joining us. We had quite a stark awakening this week because of the carry trade. It's nice to have you because of what we're seeing with possibility of a U.S. recession. How would you describe the health of the U.S. economy right now?
I tend to agree with the people, Francine, that fundamentally, the American economy is both absolutely and relative to other places really quite healthy. There's some signs of weakness, but basically it's proving to be remarkably resilient. And some of the shocks that are being delivered elsewhere, we're really not very vulnerable. Energy and that kind of thing. So I'm fundamentally cautiously optimistic that we'll continue to grow. Now, there are negative factors affecting not just the U.S. economy that, mean that our growth is slower. Productivity growth is not yet rebounded, and that kind of thing. But that doesn't tip you into recession. That just constrains the growth going forward.
Do you worry about the labor market, Michael? I mean, this is one of the biggest concerns. On Friday, we saw a bit of disappointment. This comes on the back of, again, stronger productivity, much stronger U.S. economy. And if the labor market gives, whilst, is that on the back of a significant tightening in a short amount of space, or is it a cycle?
No, I don't think it's a cycle. I mean, I think, this is a kind of high wire act that the central banks are trying to, navigate, right? So there's no question that by raising interest rates and trying to bring them down at a measured pace, they're trying to engineer a kind of controlled reduction in aggregate demand sufficient to take away some of the initial or inflationary pressures that resulted from excess demand. And so far, I think they're, doing a pretty good job in a pretty complex environment. If somehow, that high wire act gets out of balance, then you could see a drop in aggregate demand and some weakness in the labor market. But so far, the movements that we've seen, including, a lower, aggregate new employment figure, last week, or I think it was at the end of last week. I don't think this is a sign that they've kind of missed the mark. The market volatility, I tend to discount. These are not signs that there's some fundamental problem lurking in the near future.
I mean, you did some wonderful research on markets and the labor markets that they gave you a Nobel Prize for it. Are you comfortable that actually the way the market is working or the market function is doing okay right now? Or are there spots in the markets that we should be worried about?
Well, on a slightly longer term time horizon, Francine, there's if it's true, and I'm one of the people who believe it's true, that we're in a period of very rapid structural change, driven by, technology and shifts in the way the global economy works. That means there's a lot of, moving around, job change, different skills and so on. And those things are lurking in the background. And so it's easy to see that we'll get, places where there are labor shortages, places where the skills aren't, the ones that are consistent with what business and the demand side wants and so on. So I don't discount that at all. I mean, this is going to be a pretty turbulent period for the rest of the decade. But on the kind of short run, fundamentals that the central banks deal with, I haven't seen anything yet that's particularly worrying.
I know you've written extensively about the AI economic revolution and how that changes productivity and how that changes also some of our models. Are we underestimating or overestimating estimating how quickly that AI revolution comes?
I would say we're overestimating how quickly it comes. It's a sort of natural tendency that we've seen before. So, that once people realize what the potential is, then there's enormous enthusiasm. It's reflected in investment levels that are just enormous right now, in asset prices and valuations and so on. But history sort of teaches us, I mean, this may occur a little faster than, previous episodes of digital adoption, for example. But the fundamentals are, it takes very big changes in business models, individual behavior, skills, learning, experimentation and all that kind of thing that, so I don't expect AI to produce noticeable shifts in the productivity trajectory of the U.S. economy for a few years yet. I mean, data tends to lag, but I would say end of the decade. If we're not seeing it, then I think the predictions that people like me have made that it has the potential to produce a productivity surge will start to get questioned, because that's long enough to engineer these changes that are needed.
But, Michael, at the same time, we're seeing more and more crises, and it seems that, the rate of developing these crises and them lasting is exponentially higher than it was 10, 15 years ago. You actually wrote a book about this with Mohamed El-Erian and Gordon Brown called Permacrisis, a plan to fix a fractured world. Are we dealing with too many crises at the same time?
Well, it would be nice if we didn't have them, but yes, we are. And as a result of that, the global economy is being reconstructed architecturally in a really quite different way. I mean, you can, you at almost every level, business, supply chains, et cetera, you can see this pattern of diversification. I mean, I just recently learned that the Chinese entrepreneurs are busy diversifying their operations because they're good at what they do in the manufacturing sector into a whole range of other, developing countries where they're hopeful that they can not only achieve, high productivity, high growth, but to some extent, evade the sanctions that and other, fragmentary blockages that are a feature of the global economy now. So it's just it's a different world. It is driving quite a lot of structural change. It's a more complicated world, and it's a riskier one than what we were used to before. But what Gordon and Mohammed and I feel is it's pretty much inevitable. It's hard to see that climate shocks, wars, potential pandemics, and other things are simply just going to vanish in the next little while. So I think what investors and business people are busy adjusting to what amounts to a new reality, for instance.
But is this exacerbated, or is this because of divisive politics? We have the U.S. election coming up, probably the most important in the world. Who's looking at, who's thinking about the right way of fixing the economy?
Well, it's very hard to think of a way to kind of fix the global economy in terms of levels of the cooperation where it really matters. If the political underpinnings are at the domestic level, in wherever, in Europe, in the United States, et cetera, in China, are heading off in a different direction. I mean, from an external, Americans are consumed by the upcoming election, as they should be, but so are, the rest of us. I mean, I think it may, at the risk of stating something obvious, the outcome of that election has material consequences for Europe, for example, in terms of defense, support for NATO, the Ukraine war, and trade and investment flows. So, everybody's kind of holding their breath, I guess is the way I would say it. The bottom line is, I think an absolutely essential ingredient of achieving as best we can reasonable levels of global, cooperation and integration that makes sense is reasonably stable and sensible domestic politics. So that's the hoped for outcome. I'm not choosing sides here. I'm actually delighted that the American election is now in at least a full-blown competition, and that's a good thing for democracy.
Michael, thank you so much for joining us. Michael Spence, Nobel laureate and senior fellow at Stanford's Hoover Institution. We'll have plenty more, of course, with Michael throughout the next couple of weeks. Now, coming up, as the Paris Olympics comes to an end this weekend, the games are almost over, but some companies are using AI to keep the flame alive. We discuss all of this with Amazon Web Services Managing Director for EMEA. That's next, and this is Bloomberg. After 2 weeks of grit, determination and sporting excellence, the Paris Olympics comes to an end this weekend. Now, as sport and fitness continues to play a bigger role in our daily lives, some companies are looking to use AI to advance it further. Now, one of those companies is Amazon Web Services. We're now joined by Tanuja, the Managing Director and Vice President for EMEA. Tanuja, thank you so much for joining us. I've seen everyone was kind of glued to the screens to try and understand the longer. It feels very wholesome, actually, to look at some of these Olympians trying to compete for gold. How do you think you've changed the way that sports is seen across the world?
Well, it's just wonderful to be joining you here, Francine. So thank you for having me. And isn't it just the most exciting time at the sort of grand dam of sports, let's say? But sports is a really interesting vehicle to showcase the power of data. Every sports person, whether you're a cyclist or a swimmer or a gymnast, there's just an enormous amount of data that they're generating. I mean, as an example, in the Bundesliga match, for example, 3.6 million data points gets generated every match. And what we do is we take that data, we collect and analyze it, and then we apply a number of AI machine learning insights to it. So the sports teams, whether you're a team, an athlete, a coach, are getting the most out of that data to be able to improve performance, to be able to worry about health and safety, and of course, very importantly for us, the fan engagement aspect as well. So I'll give you one example, because we're in the middle of the Olympics. The national swimming team of Australia, we've been working very closely with their coaches, taking their training footage, applying machine learning and insights to that, giving that back to the coaches, and they're able to really get their team combinations in a way that allows them to really go for gold. And in the Tokyo Olympics, they won 9 golds as a result, and here they're actually doing very well as well. So they're really getting their performance improvement out of the understanding of that data and the insights generated.
I mean, Tanuja, I imagine this is like at all levels, right? You have to, first of all, recruit a young kid that's going to perform extraordinary. Once you have that young kid, it's about making sure that you coach him or her in the right way. And then it's also looking at the opponents. If you break it down, where is this analysis more useful? Do you have data on that?
Yeah, it's actually in all, I would say it's across the life cycle. Because, I mean, of course, you have to start with human performance at the end of the day. But what data is doing is allowing these coaches to really help those athletes understand where they're good, where they need to develop further by combining the historical data they've got with the real-time data and then feeding insights back. So, you know, I'll give you another very good example in motorsports, for example. You know, every one of those F1 cars, as an example, has, 300 sensors during a match, right? During a race. During that race, you get 1.1 million data points coming off the pit and coming off the cars into the pits. The teams are looking at that data. They're feeding it back in terms of providing drivers a view of what they should do. So should you overtake? Should you pause? Should you come back into the pit? Should you change your tires? So you have action during the race, action before, and then afterwards, post-analysis on really looking at how you can further improve. So it's really the whole life cycle that the data and insight gets used.
I mean, there are a number of also gold medalists who actually did much better than the record currently. How much is that helped by data analysis and helping them and actually achieve better? I mean, some of the things that we see on TV, you just can't believe that a human's doing that.
Yeah. Well, humans do perform incredibly, really, especially under that moment of stress. And, I mean, it is so much training that goes into making these athletes amazing. But, when the difference between silver and gold, milliseconds matter. And it's during that time that the data and insight is probably at its most powerful, right? So again, back to that swimming team example I was giving you earlier, what they're able to do is say, right, this combination of relay teams is going to be better than this combination of relay teams. They're able to track trajectories in terms of what the ending point will be for those swimmers in the race. They're able to look at competitive combinations. And then when they put that together, you get magic, right? So it really is a combination of, as you said, human performance and the data, but not data alone, because data alone is not very useful. It's the AI and machine learning applied to that data that gives you all of that knowledge and experience to draw insights.
I mean, is it also changing the way we look at and see and how Formula One is driven?
Well, I tell you, fan engagement is a very interesting angle, Francine, to talk about, because fans are really, really hungry for this data. They don't want to just be on the scene, as they say. They want to be behind the scenes. They want to understand what's the strategy that's being applied, right? How should I think about driver A versus driver B? By the way, we've been working very closely with F1 as well to really redesign the cars. Overtaking is a big thing. And so really redesigning the cars to help with the overtake patterns, for example, using high performance computing. But I'll give you a really good one. We developed this thing called F1 Insights with F1, using, by the way, 70 years of their historical data, combining that with our real-time data. And those F1 Insights are then fed back to fans. So one of the ones I really like is who's the fastest driver? And everyone has their own view on who's the fastest driver through history. And with the F1 Insights, we were able to show actually that it's always been Senna who's been the fastest driver. But when you ask people that question, they come back with just different answers. But that's one of those examples. It's all about, speed, overtake. Are you too close to the edge? And it's very powerful for F1, for the teams, as well as actually the drivers themselves.
Tanuja, I know it's been also a tough week for tech stocks and AI in general. We're not going to get onto it now. But do you think we're underestimating how much AI is also transforming some of the entertainment, some of the things that we like on doing? Do you feel like it often gets a bad rep?
Well, I tell you, I really feel, and we're very convicted about this, this is a transformative technology. It's probably more transformative, Francine, than the cloud when it was introduced, and probably even the internet, I would say. And the reason it's transformative is it can actually augment or accelerate or automate pretty much any process in any sector. We've done some recent research, by the way. It's our Unlocking Ambitions report. We've seen an uptake in the increase of AI by European businesses by 30%. And when you look at that and convert that to what would that mean for the economy, you're talking about the potential of 600 billion euros of economic value that could be unlocked as a result of AI. But as I heard your previous guest on the show, it isn't just about the AI. What we need to do is make sure that there's choice and availability of models, for example. We do that through our Amazon Bedrock platform. We need to make sure it's secure. There's enterprise-grade security. People know where their data is. They know it's secure. And then we need to make sure we build confidence by having responsibility around the AI. And we're very committed to this, by the way, by introducing things like guardrails, where it actually removes harmful content up to 85%. Making sure that we're removing biases from the data that people are working on in these programs. So it's really, really important that those three things are there. But I think the other important thing is skills. The lack of digital skills is probably the biggest issue and obstacle that we see, not the technology, not the infrastructure. And we're super committed to also making sure we train millions of people around the world. Actually, we've trained 31 million people for free around the world.
Tanuja, thank you so much. We'll have to get you back on to dig a little bit deeper into that. Tanuja Randery, the Managing Director and Vice President for EMEA for Amazon Web Services. Now, coming up, we'll look at how a former Google engineer has become the richest person in China. That's next, and this is Bloomberg. Colin Huang, the tech tycoon and founder of e-commerce giant Temu, has become China's richest person. Now, he replaces Zhang Shangshan, the country's bottled water king, who held the top spot since April 2021. Now, joining us now to discuss all of this is Bloomberg's Charlie Walz. Charlie, this is exciting. I mean, for him, but also for us because we get to cover the story. Who's Colin Huang?
You know, he kind of represents a new generation of billionaire in China, and one who's, you know, quite different from Jack Ma, who I think is a very household name for people. He's younger, he's 44, but he really had that kind of global experience that a lot of older billionaires didn't have. He got a degree from the University of Wisconsin and then helped start Google in China.
So what do we know about Temu? I mean, all I know is every time I'm on Google or another search engine, it always comes up for anything I'm looking for.
So much advertising. And I kind of bill it as the sort of cheaper Amazon.com. So, you know, owned by PDD. It really got its international blow up in 2022 and sort of has been the app of the moment because it sells cheaper products to people from the internet.
He's 44 years old. Do the good times continue for Temu and him?
It's difficult, right? Because there are these tensions between the West and China ramping up. It's going to be sort of a punching bag. And I think a lot of the questions that people in China and outside have been asking is, how is this stuff so cheap? And there could be legislative changes surrounding that.
Okay, but we've definitely asked for an interview. So
good.
Let's see.
It would be a good one.
It would be an amazing interview. Charlie, thank you so much. Charlie Walz there with the newest, of course, richest person in China. Up next, a Bloomberg Brief with Manus Karani in New York, and this is Bloomberg.